Let's talk about leverage. It's a term you hear a lot in the financial world, and understanding it is crucial, especially if you're looking to grow your wealth. But it's not just for Wall Street pros. It impacts everyday Americans through mortgages, car loans, and even investment strategies. So, what exactly is leverage? Simply put, leverage is using borrowed capital to increase the potential return of an investment. Think of it like using a crowbar to lift something heavy. The crowbar, the leverage, allows you to exert more force with less of your own effort. In finance, that effort is your capital. Let's look at a simple example. Imagine you want to buy a rental property that costs $200,000. You have $40,000 saved for a down payment. Without leverage, you'd need another $160,000 to buy it outright. But with leverage, you could get a mortgage for $160,000, putting down your $40,000. Now, let's say that property generates $20,000 in rental income per year. Without leverage, your return on investment is calculated on your total investment of $200,000. That's a 10% return, pretty good. But with leverage, your return is calculated on just the $40,000 you actually put up. That's a massive 50% return. See how leverage amplifies your gains. That's the biggest advantage of leverage, the potential for higher returns. It allows you to control a larger asset with a smaller amount of your own money. This can significantly accelerate wealth building. It's why many real estate investors use mortgages and why traders use margin in the stock market. But here's where it gets tricky. Leverage isn't free. You're borrowing money and you have to pay interest on that borrowed money. In our rental property example, your rental income needs to cover not just property taxes and maintenance, but also your mortgage payments. If your rental income doesn't cover those costs, you're losing money, and leverage is actually working against you. And that brings us to the biggest risk of leverage: amplified losses. Just like it can magnify your gains, it can also magnify your losses. Let's say instead of generating $20,000 in rental income, the property generates only $10,000 and you still have to pay the mortgage. Now, instead of a positive return, you're losing money. And because you're using leverage, those losses are magnified, meaning you could lose your initial investment, and more, much faster than if you hadn't used leverage. Let's look at another example: stock trading. Let's say you want to buy $10,000 worth of a stock, but you only have $2,000. Using margin, a type of leverage, you can borrow the other $8,000 from your broker. If the stock goes up 10%, your profit is $1,000, which is a 50% return on your $2,000 investment. Great. But if the stock goes down 10%, you lose $1,000. And because you borrowed money, you're still responsible for paying back the $8,000 plus any interest. A margin call could force you to sell your stock at a loss to cover your debt. The level of risk depends on several factors. The amount of leverage you use is key. The higher the leverage, the greater the potential reward, but also the greater the potential risk. The stability of the underlying asset is also crucial. Investing in a stable asset with leverage is generally less risky than investing in a volatile asset with leverage. And of course, your ability to repay the borrowed funds is paramount. In the United States, leverage is readily available in many forms. Mortgages are a common form of leverage for homeownership. Car loans allow you to purchase a vehicle with borrowed funds. Credit cards are a form of short-term leverage. And margin accounts allow investors to borrow money to trade stocks and other securities. While leverage can be a powerful tool for wealth creation, it's not a magic bullet. It's essential to understand the risks involved and to use it responsibly. Before using leverage, carefully consider your financial situation, your risk tolerance, and your investment goals. Don't borrow more than you can comfortably afford to repay, and always have a plan for dealing with unexpected losses. Diversification is also crucial. Don't put all your eggs in one basket, especially when using leverage. To recap, Leverage is using borrowed capital to amplify potential returns and potentially losses. It's common in mortgages, car loans, and investment strategies. While it offers the potential for higher gains, it also increases risk. Understanding the terms, your risk tolerance, and responsible borrowing are essential for successful leverage utilization. It's a powerful tool, but it needs to be wielded with caution and knowledge. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.